If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge, and when we help others grow, we grow too. Thank you so much for listening. Let's dive into the book. Chapter 1, The Treasure Map, Finding Hidden Gems. Part 1, The Hunt for Value. Value investing transforms the complex world of stock markets into something resembling an exciting treasure hunt. Picture yourself as an explorer with a map, searching for precious gems that others have overlooked or dismissed. The most successful investors in history approached their craft this way, treating each potential investment as a mystery to solve rather than a gamble to take. This mindset separates genuine wealth builders from short-term speculators, creating opportunities for those willing to dig deeper than surface appearances suggest. The legendary Benjamin Graham, often called the father of value investing, spent his career searching for companies trading below their true worth. Like an archaeologist examining artifacts, he studied financial statements and business fundamentals to find hidden treasures in plain sight. His approach resembled a methodical treasure hunter who understood that the most valuable discoveries required patience and careful investigation. Graham's student, Warren Buffett, took this treasure-hunting mentality and refined it further. Instead of simply looking for cheap stocks, Buffett searched for exceptional businesses temporarily available at reasonable prices. He compared his process to finding dollar bills selling for 50 cents, but with the added requirement that those dollars belong to companies with bright futures. Consider the story of Lisa, a teacher who decided to try value investing after watching her retirement account struggle through market volatility. Instead of chasing popular stocks making headlines, she began studying companies most investors ignored. She discovered a small regional bank trading at half its book value because investors feared regulatory changes. After months of research, Lisa found the bank had excellent management, strong local relationships, and enough capital to weather any regulatory storms. 3 years later, the market recognized what Lisa had discovered, and her investment doubled. What drives someone to become a successful value hunter? The answer lies in developing a curious mindset that questions conventional wisdom. When everyone believes a company is finished, the value investor asks whether the market might be wrong. When stocks soar to ridiculous heights, they wonder if people have lost their minds. This contrarian thinking requires emotional strength and intellectual honesty. The treasure hunting process begins with understanding that markets often behave irrationally. Companies with solid businesses sometimes see their stock prices crash due to temporary problems or investor panic. Other times, mediocre companies trade at sky-high prices because they operate in fashionable industries. The value hunter profits from these disconnects between price and actual worth. Think about how antique dealers operate at estate sales. While casual buyers focus on shiny, obvious items, experienced dealers examine pieces others ignore. They understand that true value often hides beneath tarnished surfaces or outdated appearances. Similarly, value investors study companies others have written off, searching for hidden strengths and future possibilities. Marcus, a plumber who started investing in his 40s, learned this lesson firsthand. He noticed that a construction supply company in his area had an excellent reputation among contractors, but saw its stock price collapse during a housing downturn. While financial news painted doom scenarios, Marcus recognized that the company's strong customer relationships and efficient operations would survive any temporary slowdown. He bought shares at rock-bottom prices and held them through the recovery, earning returns that exceeded his wildest expectations. How do you develop the patience required for this treasure-hunting approach? The answer involves changing your relationship with time itself. Instead of viewing investments as lottery tickets that should pay off quickly, successful value hunters treat them as seeds that need time to grow. They understand that the market eventually recognizes quality, but this recognition might take months or even years to arrive. The treasure hunting mindset also requires accepting that not every dig produces gold. Professional treasure hunters expect many failed expeditions for every major discovery. Value investors similarly understand that some investments will disappoint, but the successful ones more than compensate for the failures. This acceptance of occasional setbacks prevents the emotional turmoil that destroys most amateur investors. Graham taught his followers to approach investing like scientists conducting experiments. They form hypotheses about a company's value, test those hypotheses through research, and remain open to changing their minds when evidence contradicts their initial beliefs. This scientific approach removes emotion from decision-making and focuses attention on facts rather than feelings. Have you ever noticed how the best opportunities often appear during the worst times? Experienced treasure hunters understand this paradox and prepare themselves to act when others retreat. During market crashes, financial crises, or industry downturns, exceptional companies sometimes become available at bargain prices. The hunters who remain calm and continue searching during these storms often find their most profitable investments. The adventure of value investing rewards those who combine patience with action, curiosity with discipline, and optimism with realism. It transforms the potentially stressful experience of market investing into an engaging intellectual pursuit where success comes to those willing to think differently and act independently. Part 2. What makes a gem shine? Every successful treasure hunter knows that not all glittering objects are gold. The same principle applies to investing, where countless stocks appear attractive on the surface, but only a select few possess the qualities that create lasting wealth. This section explores the essential characteristics that transform an ordinary company into an investment gem. Readers will discover how to evaluate financial strength, identify competitive advantages, and assess management quality through real-world examples and proven frameworks that separate genuine opportunities from fool's gold. Picture a diamond cutter examining a rough stone. To an untrained eye, the stone might look worthless, covered in dirt and showing no obvious beauty. Yet the expert sees beyond the surface, recognizing the crystal structure, clarity, and potential that others miss. Value investing operates on this same principle of looking deeper than appearances. Consider the story of Rachel, a retired teacher who inherited some money in 2008. While most investors fled the stock market during the financial crisis, Rachel noticed something interesting about Johnson & Johnson. Despite the market panic, people still needed bandages, medicine, and healthcare products. The company had been profitable for decades, carried little debt, and dominated markets that competitors struggled to enter. While J&J's stock price had fallen with everything else, its fundamental business remained strong. Rachel bought shares at what seemed like a bargain price, and her patience was rewarded as the stock recovered and continued growing over the following years. What made Johnson & Johnson attractive wasn't its stock price alone, but rather its underlying business qualities. These characteristics form the foundation of what value investors call a quality company. The first quality to examine is financial health, which acts like a company's vital signs. Strong companies generate consistent cash flow, much like a reliable paycheck allows you to pay bills and save money. When examining a potential investment, look for businesses that produce more cash than they spend, year after year. This cash generation ability indicates that customers truly value what the company provides and are willing to pay for it repeatedly. Debt levels provide another crucial indicator of financial health. Companies carrying excessive debt resemble people living paycheck to paycheck, vulnerable to any unexpected problems. During economic downturns, heavily indebted companies often struggle to make payments and may face bankruptcy. In contrast, companies with manageable debt levels maintain flexibility to invest in growth opportunities or weather difficult periods. The concept of competitive advantages, often called economic moats, represents perhaps the most important quality separating great investments from mediocre ones. Think of a medieval castle surrounded by a water-filled moat. Enemies found it nearly impossible to attack because they couldn't easily cross the protective barrier. Similarly, companies with strong competitive advantages possess protective barriers that prevent competitors from stealing their customers or profits. These advantages take various forms in the business world. Brand recognition creates customer loyalty that competitors struggle to break. When Marcus needs cola for a party, he automatically reaches for Coca-Cola without considering alternatives. This brand preference allows Coca-Cola to charge premium prices and maintain market share despite numerous competitors offering similar products. Network effects represent another powerful form of competitive advantage. Social media platforms become more valuable as more people join them. Facebook attracted users partly because their friends were already there, creating a self-reinforcing cycle that made it difficult for competitors to gain traction. Each new user made the platform more attractive to others, building an increasingly strong protective moat. Cost advantages allow some companies to offer products at lower prices while maintaining healthy profits. Walmart built a massive distribution system and negotiated favorable supplier terms that smaller retailers cannot match. This cost structure enables Walmart to offer competitive prices while still earning profits, making it difficult for new competitors to undercut them successfully. Have you ever wondered why some businesses seem to thrive regardless of economic conditions, while others struggle constantly? The answer often lies in the strength of their competitive advantages and the sustainability of their business models. Management quality represents the third pillar of investment gems, though it proves more challenging to evaluate than financial metrics. Exceptional managers allocate capital wisely, make decisions that benefit long-term shareholders, and navigate challenges with skill and integrity. Poor management can destroy even the most promising business opportunities. Look for management teams with significant ownership stakes in their companies. When executives own substantial shares, their interests align with other shareholders. They benefit when the stock price rises and suffer when it falls, creating natural incentives for good decision-making. Conversely, managers who own few shares might prioritize short-term results that boost their bonuses rather than building long-term value. Past performance provides insights into management capability, though it requires careful analysis. Elena researched a retail chain and discovered that its CEO had successfully expanded 2 previous companies while maintaining profitability and treating employees well. This track record suggested the manager possessed skills needed to create shareholder value. However, Elena also verified that past success came from genuine business acumen rather than favorable market conditions or accounting tricks. Management communication style reveals important character traits. Honest leaders acknowledge mistakes, explain their reasoning clearly, and set realistic expectations. They focus on business fundamentals rather than promoting their stock price. Misleading managers often make grand promises, blame external factors for problems, and use confusing language to obscure poor results. The quality of a company's products or services provides another lens for evaluation. Companies offering superior products or essential services possess natural advantages over competitors. During research, ask yourself whether you would choose this company's products over alternatives, and whether customers depend on what the company provides. Consider how CVS Health expanded beyond traditional pharmacy services to include minute clinics and healthcare services. This evolution created multiple ways to serve customers while making it harder for competitors to replicate their complete offering. Customers could fill prescriptions, receive basic medical care, and purchase health products all in one location, creating convenience that pure online retailers struggled to match. Industry dynamics significantly influence a company's potential success. Some industries naturally produce better investment opportunities than others. Businesses operating in growing markets with high barriers to entry often outperform those in declining or highly competitive sectors. Technology companies sometimes appear attractive because of rapid growth, but many operate in industries where advantages disappear quickly. New competitors can emerge overnight, and customer preferences change rapidly. In contrast, utility companies operate in stable, regulated industries where dramatic changes occur slowly, though growth prospects may be limited. The final characteristic of investment gems is often the most paradoxical. They frequently appear unattractive to most investors when they represent the best opportunities. During the 2008 financial crisis, bank stocks traded at extremely low prices because investors feared widespread failures. However, well-capitalized banks with conservative lending practices represented exceptional value for investors willing to research individual companies rather than avoiding the entire sector. This principle explains why successful value investors often think differently from the crowd. When everyone loves a stock, its price typically reflects that optimism, leaving little room for exceptional returns. When everyone avoids a stock or sector, opportunities may exist for those willing to look beyond popular sentiment and focus on fundamental business quality. What companies in your daily life demonstrate these gem-like qualities, and how might understanding their competitive advantages help you become a better investor? The ability to recognize these characteristics in real-world businesses transforms abstract investing concepts into practical skills for building wealth over time. Part 3. The power of patience. The path to exceptional investment returns often demands something that feels almost impossible in today's instant gratification world: patience. While social media floods us with stories of overnight trading millionaires and cryptocurrency fortunes made in weeks, the most successful value investors understand that true wealth accumulates through time, not speed. This section explores how patience becomes your greatest ally in building lasting wealth, examining real examples of investors who waited years for their investments to mature, and the emotional discipline required to resist the constant noise of market fluctuations. You will discover practical strategies for developing this crucial skill and learn why the slow approach often delivers the fastest path to financial freedom. Rosa Martinez discovered the power of patience by accident. In 2008, during the financial crisis, she bought shares of a well-known bank when everyone else was selling. The stock price had fallen from $80 to $12. Friends called her crazy. Financial news showed daily headlines about banking collapse. Rosa felt sick watching her investment drop further to $8. Instead of selling, Rosa did something remarkable. She stopped checking the stock price daily. She focused on the bank's fundamentals. The company had strong capital reserves, experienced management, and operations in stable markets. Most importantly, people would always need banking services. Rosa held her shares for 12 years. When she finally sold in 2020, those same shares were worth $96 each. This story illustrates a fundamental truth about value investing. The market often moves like an emotional teenager, swinging between extreme optimism and deep pessimism. Patient investors benefit from these mood swings by buying when others panic and holding when others celebrate. Warren Buffett once said he prefers holding stocks forever if the business quality justifies it. His investment in Coca-Cola demonstrates this principle perfectly. Buffett began buying Coca-Cola shares in 1988 when the company faced challenges from new competitors and changing consumer preferences. Many investors questioned whether the iconic brand could maintain its dominance. Buffett saw something different. He recognized that Coca-Cola had built an incredible global distribution network over decades. The company's brand recognition was unmatched worldwide. Even more importantly, the business generated enormous amounts of cash that could fund expansion and reward shareholders. Rather than worry about short-term fluctuations, Buffett focused on these enduring competitive advantages. The results speak volumes about patience. Buffett's initial investment of approximately $1 billion in Coca-Cola grew to over $20 billion by 2020. This transformation didn't happen overnight. It required holding through multiple market crashes, changing consumer trends, and countless predictions about the company's decline. How often do you check your investment accounts, and what emotions drive those decisions? Consider keeping a simple journal tracking your feelings when markets move dramatically. This practice helps build awareness of emotional patterns that can derail long-term success. The contrast between patient investing and active trading becomes clear when examining typical holding periods. Day traders hold positions for minutes or hours. Swing traders hold for days or weeks. Value investors often hold quality companies for years or decades. This difference in time horizon fundamentally changes how they evaluate opportunities. Take the example of Kevin Thompson, a teacher who started investing in 1995. Kevin bought shares of a small regional retailer that was expanding slowly but steadily. The company's growth seemed boring compared to the exciting technology stocks making headlines. While his friends chased internet companies with no profits, Kevin focused on his retailer's consistent earnings growth and expanding market share. The dot-com bubble burst in 2000, wiping out many high-flying technology investments. Kevin's retailer continued growing steadily, opening new locations and improving operations. By 2010, Kevin's initial $10,000 investment had grown to $60,000. The patient approach protected him from devastating losses while building substantial wealth. This story highlights an important principle. Patience protects investors from destructive behavior during market extremes. When everyone rushes toward the same popular investments, prices often exceed reasonable valuations. When panic spreads and everyone sells, opportunities emerge for patient buyers. The legendary Benjamin Graham understood this dynamic perfectly. Graham often compared the stock market to a voting machine in the short term, but a weighing machine in the long term. Daily price movements reflect emotional voting by market participants. Over years, prices tend to reflect the actual weight of business fundamentals. Graham's student, Walter Schloss, embodied this patient philosophy throughout his 50-year investing career. Schloss would buy stocks trading below their book value and simply wait. He didn't try to predict when prices would recover. He trusted that patient capital would eventually be rewarded as other investors recognized the same values he had identified. Schloss achieved remarkable results through this approach. His investment partnership generated annual returns of approximately 16% over 5 decades. This performance came not from spectacular individual wins, but from consistently applying patient discipline across hundreds of investments. What activities help you remain calm during stressful situations? And how might you apply those same techniques to investing? Building patience requires practice in low-stakes situations before applying it to financial decisions. The emotional discipline required for patient investing extends beyond simply holding stocks longer. It involves developing immunity to common psychological traps that destroy wealth. Fear of missing out drives investors to chase popular trends. Fear of losing money causes premature selling during temporary downturns. Patience serves as an antidote to both destructive emotions. Consider the experience of Lisa Chen, who worked as an engineer in Silicon Valley during the 1990s technology boom. Colleagues regularly discussed their gains from internet stocks. Lisa felt increasing pressure to abandon her conservative approach, focusing on established companies with solid profits. The temptation grew stronger as technology stocks doubled and tripled in value. Lisa made a crucial decision. She allocated 90% of her investments to proven value companies and allowed herself to speculate with the remaining 10%. This compromise satisfied her curiosity about trendy investments while protecting the majority of her wealth. When the technology crash occurred, Lisa's disciplined approach preserved her capital while many colleagues lost substantial sums. The psychological benefit of this strategy cannot be overstated. Lisa slept well during market turbulence because she knew her core holdings consisted of profitable businesses trading at reasonable prices. This peace of mind enabled her to think clearly and make rational decisions when opportunities arose. Patience also means accepting that great investments often look boring or unpopular initially. Media attention gravitates toward exciting stories about rapid growth and dramatic change. Value investments frequently involve steady, predictable businesses that generate consistent profits year after year. These companies rarely make headlines until their stock prices have already reflected their quality. The story of Tom Wilson illustrates this principle. Tom worked as an accountant and noticed that a local utility company consistently earned stable profits regardless of economic conditions. People needed electricity during good times and bad times. The company paid reliable dividends and traded at modest valuations compared to growth stocks receiving media attention. Tom steadily accumulated shares of this utility over 20 years. His friends considered the investment boring compared to their ventures into emerging markets and technology funds. However, Tom's utility investment provided steady dividend income that grew annually. Combined with gradual price appreciation, his patient approach generated superior long-term returns with much lower stress. How do you define success in your financial goals? And does your definition emphasize short-term excitement or long-term security? Clarifying your priorities helps maintain patience during challenging periods. Building practical patience requires specific strategies that counteract natural human tendencies toward impatience. One effective approach involves lengthening your measurement periods. Instead of checking investment performance monthly, consider quarterly or annual reviews. This simple change reduces exposure to meaningless short-term volatility while maintaining awareness of genuine business developments. Another valuable technique involves focusing on business progress rather than stock price movements. Companies report quarterly earnings, annual results, and strategic updates that reveal actual operational performance. These fundamental developments matter more than daily price fluctuations driven by temporary market emotions. Successful patient investors also cultivate interests and activities outside of investing. This diversification of attention prevents obsessive monitoring of market movements. When your identity and daily satisfaction don't depend entirely on investment performance, maintaining long-term perspective becomes much easier. The rewards of patience extend beyond financial returns. Patient investors experience less stress, make fewer costly mistakes, and build wealth more consistently than their impatient counterparts. They sleep better during market downturns and avoid the exhausting cycle of constantly searching for the next quick profit. Most importantly, patience aligns your behavior with the natural rhythm of business development and wealth creation. Great companies need time to execute their strategies, compound their earnings, and build lasting competitive advantages. Patient investors benefit from this natural process rather than fighting against it through premature buying and selling decisions. Part 4. Learning from legends. Learning from the giants of value investing reveals that mastery comes not from following complex formulas, but from developing simple, powerful habits that compound over time. These legendary investors faced the same market chaos we see today, yet they built extraordinary wealth by sticking to fundamental principles while adapting their methods to changing circumstances. Their stories show us that success in value investing requires both unwavering discipline and the flexibility to learn from mistakes. Through examining their journeys, we discover practical wisdom that transforms how we approach the market and build lasting wealth. Benjamin Graham's story begins during the Great Depression, when most investors were running from stocks. While others panicked, Graham saw opportunity. He developed his approach after losing nearly everything in the 1929 crash, determined never to repeat those mistakes. Graham's method was simple yet revolutionary. He looked for companies trading below their liquidation value, buying dollar bills for 50 cents. Graham's most famous example involved Northern Pipeline Company in 1926. The company held valuable railroad bonds worth more than its entire stock price. Graham bought shares, forced management to distribute the bonds to shareholders, and earned a substantial profit. This experience taught him that patient research could reveal hidden value that markets overlooked. What made Graham different was his systematic approach. He created checklists and criteria that removed emotion from investment decisions. His margin of safety concept protected investors from permanent loss while still allowing for substantial gains. Graham proved that investing could be both safe and profitable if approached with discipline and patience. Warren Buffett learned from Graham, but adapted the teachings to focus on quality businesses rather than just cheap prices. In 1988, Buffett made one of his most famous investments in Coca-Cola. The stock had fallen due to market concerns, but Buffett recognized the company's powerful brand and global reach. He invested over $1 billion when others questioned the decision. Buffett's Coca-Cola investment demonstrates how legends think differently about time and value. While critics worried about short-term price movements, Buffett focused on the company's ability to generate cash for decades. His patience paid off as the investment grew to become worth over $20 billion. The lesson from Buffett's approach is clear. Great investors buy wonderful companies at fair prices rather than mediocre companies at cheap prices. This shift in thinking allows investors to hold positions longer and benefit from compound growth rather than just price appreciation. Have you ever considered how your investment criteria might need to evolve as you gain experience and market conditions change? Peter Lynch, who managed the Magellan Fund, brought value investing to everyday investors by encouraging them to invest in what they understood. Lynch's philosophy was simple. Ordinary people could find great investments by observing the world around them. He discovered Dunkin' Donuts by noticing long lines at their stores and bought shares before Wall Street analysts paid attention. Lynch's approach shows that legendary investors don't always use complex analysis. Sometimes the best opportunities come from careful observation of everyday business success. His 10-year track record of beating the market by enormous margins proved that simple methods could produce extraordinary results. Lynch also taught investors about different types of stocks and when to buy them. He categorized companies as slow growers, stalwarts, fast growers, and turnarounds. Each category required different expectations and holding periods. This framework helped investors match their strategy to the specific situation rather than applying one approach to all investments. John Templeton built his reputation by being contrarian when it mattered most. In 1939, as World War II began and markets collapsed, Templeton bought 100 shares of every stock trading below $1 on major exchanges. This bold move, made when pessimism was extreme, generated enormous returns as the economy recovered. Templeton's strategy teaches us that the best opportunities often come disguised as disasters. When everyone else is selling in panic, patient investors can find incredible bargains. However, this requires both financial resources and emotional strength to act when circumstances appear most frightening. What separates legendary investors from average ones is their ability to maintain perspective during emotional extremes. Templeton's success came from recognizing that markets overreact to both good and bad news, creating opportunities for those willing to think independently. Walter Schloss, another Graham student, took a different path by focusing exclusively on deeply undervalued stocks. Schloss worked alone in a small office, avoiding the distractions of Wall Street. He bought stocks trading below book value and held them until the market recognized their worth. His 47-year track record shows that simple methods, consistently applied, can beat sophisticated strategies. Schloss proves that successful value investing doesn't require complex tools or constant market monitoring. His approach was methodical and patient, buying when others were selling and waiting for value to be recognized. This long-term perspective allowed him to benefit from market cycles rather than being hurt by short-term volatility. The legends also made mistakes and learned from them. Buffett's investment in Berkshire Hathaway, originally a failing textile company, taught him to focus on great businesses rather than turnaround situations. Graham admitted that his rigid focus on quantitative measures sometimes caused him to miss exceptional companies with strong competitive advantages. These failures became valuable lessons that shaped their future success. The willingness to acknowledge mistakes and adapt strategies separated these investors from those who stubbornly stuck to failing approaches. Their humility and continuous learning mindset contributed as much to their success as their analytical skills. How do you currently handle investment mistakes, and what systems do you have in place to learn from them? Modern value investors continue building on these foundations while adapting to new market conditions. The principles remain constant, but applications evolve with technology and changing business models. Today's value investors still seek margin of safety, focus on intrinsic value, and maintain long-term perspectives, but they may apply these concepts to software companies or emerging markets rather than traditional manufacturing businesses. The path these legends traveled shows that becoming a successful value investor requires patience, discipline, and continuous learning. Their stories demonstrate that anyone can develop these skills through practice and dedication. The markets will always provide opportunities for those prepared to recognize and act on them with wisdom gained from studying the masters. Chapter 2. The Safety Net, Protecting Your Gold. Part 1. Margin of Safety, Your Secret Weapon. Imagine having a personal bodyguard for your money, someone who stands between your investments and potential disaster. This bodyguard doesn't carry weapons or wear sunglasses. Instead, it uses the simple but powerful principle of buying stocks for far less than they're actually worth. This concept, known as margin of safety, has protected smart investors for decades and can transform how you approach the stock market. When you master this principle, you create a buffer that shields you from mistakes, market crashes, and the countless surprises that financial markets throw at even the most careful investors. Think of margin of safety like buying a house worth $200,000 for just $140,000. Even if you made errors in estimating the true value, even if the neighborhood declined slightly, you still have room for things to go wrong without losing money. This same logic applies to stocks, and it's what separates successful long-term investors from those who get wiped out during market storms. Elena discovered this principle the hard way. In 2019, she bought shares of a technology company trading at $50 per share. Her research suggested the company was worth about $52 per share, a small profit margin that seemed reasonable. When the market crashed in 2020, the stock plummeted to $30. Elena lost nearly 40% of her investment because she had bought with almost no safety buffer. Compare this to her friend Marcus, who only bought stocks when they traded for 60% or less of his calculated fair value. When he found that same technology company trading at $35 per share while believing it was worth $60, he made his purchase. Even during the market crash, his investment held up better because he had built in a $25 per share cushion. The margin of safety principle works because it acknowledges a fundamental truth about investing. We're all going to be wrong sometimes. No matter how carefully you research a company, no matter how detailed your analysis, you will make mistakes in estimating what a business is truly worth. Markets will surprise you. Economic conditions will change in ways you didn't expect. Consider the story of David, a small business owner who started investing in 2015. He spent months analyzing a retail chain, concluding it was worth $40 per share. When the stock dropped to $38, he thought he had found a bargain and invested $10,000. Within 2 years, online shopping trends he hadn't fully considered devastated the company, and his investment became nearly worthless. What went wrong? David's analysis wasn't necessarily flawed, but he gave himself no room for error. He bought close to what he thought the company was worth, leaving no cushion for the unexpected changes that hit the retail industry. The greatest investors in history have built their fortunes by demanding this safety margin. They understand that being approximately right with a large margin of safety beats being precisely right with no buffer. When you buy a stock for $30 that you believe is worth $50, you can be wrong about the true value by $15 and still break even. How do you determine if you have adequate margin of safety? The answer varies depending on your confidence in the analysis and the stability of the business. For well-established companies with predictable earnings, a 25 to 30% discount to fair value might suffice. For smaller or more volatile businesses, you might demand a 50% discount or more. Rachel learned to apply different safety margins based on business quality. When she analyzed a stable utility company, she was comfortable buying at a 20% discount to her calculated value. But when evaluating a small mining company with unpredictable earnings, she insisted on buying for less than half her estimated worth. The margin of safety also provides psychological benefits that many investors overlook. When you know you bought a stock for significantly less than it's worth, you're less likely to panic during temporary market declines. This emotional steadiness often proves more valuable than the mathematical protection. Think about how you feel when you buy something on sale versus paying full price. If you bought a $100 jacket for $60, you feel good about the purchase even if the jacket goes on sale for $50 later. But if you paid full price and then saw it marked down, you'd feel frustrated. The same psychology applies to stocks. What specific margin do you think would help you sleep better at night when markets become volatile? This personal comfort level should influence how you approach each investment decision. Building margin of safety into your investment approach requires patience and discipline. It means passing on stocks that seem reasonably priced but don't offer enough cushion. It means accepting that you'll miss some opportunities because your price targets seemed too low. This patience pays off over time. Markets regularly present opportunities to buy quality companies at significant discounts. Economic fears, temporary business problems, or simple market overreactions create these moments when margin of safety becomes available to prepared investors. The margin of safety principle transforms investing from gambling into calculated risk-taking. It provides the foundation for building wealth while protecting against the inevitable mistakes and surprises that await every investor in the financial markets. Part 2. Avoiding fool's gold. Spotting value traps requires the trained eye of a detective combined with the caution of a surgeon. These investments appear cheap on the surface but hide serious problems that can destroy your wealth. Smart investors learn to separate genuine opportunities from these deceptive deals through careful analysis and healthy skepticism. The ability to avoid these traps becomes just as important as finding real bargains, protecting your portfolio from costly mistakes that can take years to recover from. Consider the story of Elena, a careful investor who spotted what seemed like an incredible deal. A once mighty retail chain traded at just 5 times earnings, a fraction of its historical valuation. The company had dominated shopping malls for decades, and the low price seemed to offer enormous potential returns. Elena calculated that even modest improvements would double her investment. She bought heavily, convinced she had found a true bargain. Within 2 years, online shopping had crushed the company's business model. Store closures accelerated, debt payments became impossible, and the stock eventually became worthless. Elena learned that cheap prices don't always mean good value. Value traps typically share several warning signs that careful investors can identify. Companies facing permanent industry decline often trade at low prices for good reason. Newspapers, traditional book retailers, and many brick-and-mortar businesses fell into this category as digital alternatives transformed their industries. Financial distress creates another common trap. When companies carry too much debt relative to their earnings, even small problems can trigger bankruptcy. The seemingly attractive low price reflects the high probability of total loss rather than genuine opportunity. Think about Marcus, who noticed a mining company trading at rock-bottom prices during a commodity downturn. The balance sheet showed massive debt taken on during the previous boom cycle. While commodity prices eventually recovered, the company couldn't survive long enough to benefit. High debt loads had turned a cyclical business problem into a permanent disaster. Poor management represents perhaps the most dangerous trap of all. Companies led by incompetent or dishonest executives can destroy value regardless of how cheap their stock appears. These leaders make poor capital allocation decisions, enter failing ventures, or even engage in fraud that wipes out shareholder value completely. Have you ever been attracted to an investment simply because the price had fallen dramatically? This emotional response often leads investors directly into value traps. Quality businesses rarely trade at truly bargain prices for extended periods. When excellent companies with strong competitive positions, growing markets, and capable management teams become cheap, smart money typically recognizes the opportunity quickly. Prices that seem too good to be true usually are. The key lies in understanding why a stock trades cheaply. Temporary problems affecting solid businesses create genuine opportunities. A food company facing a product recall, a bank dealing with regulatory issues, or a retailer experiencing supply chain disruptions might all recover once these specific problems resolve. Permanent problems tell a different story. When fundamental changes threaten a company's entire business model, low prices often accurately reflect bleak prospects. The challenge lies in distinguishing between temporary setbacks and permanent decline. Consider Rachel's approach to analyzing cheap stocks. She always asks 3 critical questions before investing. First, is this a good business facing temporary problems or a declining business in permanent trouble? Second, does management have the skills and integrity to solve current challenges? Third, will this company exist and prosper in 5 years? These questions helped Rachel avoid numerous traps while identifying genuine opportunities. When a pharmaceutical company's stock crashed following patent expirations, she recognized that the underlying business remained strong with a promising drug pipeline. The temporary earnings decline masked long-term value creation potential. Financial statement analysis becomes crucial for avoiding traps. Companies can manipulate earnings through accounting tricks that make troubled businesses appear profitable. Revenue recognition games, expense deferrals, and other techniques can hide deteriorating fundamentals for surprisingly long periods. Cash flow analysis often reveals problems that earnings statements conceal. When companies consistently generate less cash than reported profits, warning bells should sound. Real businesses ultimately succeed or fail based on their ability to generate actual cash for shareholders. Debt analysis deserves special attention in trap detection. Companies with high debt-to-equity ratios face constant refinancing risks. When credit markets tighten or business conditions deteriorate, these companies can quickly become distressed regardless of their operational performance. The technology sector provides numerous examples of value traps disguised as opportunities. Many once dominant companies failed to adapt to changing technologies and consumer preferences. Their low valuations reflected accurate assessments of declining prospects rather than temporary mispricing. What steps do you take to verify that an apparently cheap stock represents genuine value rather than a trap waiting to spring? Industry analysis helps identify sectors facing structural challenges versus temporary difficulties. Declining industries rarely produce successful value investments, while temporarily out-of-favor sectors in growing markets often do. Competition analysis reveals whether a company's problems stem from specific missteps or broader competitive disadvantages. Companies losing market share to superior competitors face different challenges than those dealing with temporary operational issues. The most successful value investors combine quantitative analysis with qualitative judgment. They refuse to buy stocks based solely on low statistical measures like price-to-earnings ratios. Instead, they demand understanding of the business, its competitive position, management quality, and future prospects. Building this analytical framework takes time and practice. Start by studying companies you understand and industries you know. Learn to read financial statements critically, focusing on cash generation and debt levels. Develop the patience to wait for opportunities where quality meets genuine cheapness. Remember that missing a good opportunity costs less than falling into a value trap. The former represents foregone gains, while the latter creates actual losses that require superior performance elsewhere just to break even. Maintaining capital preservation as your primary goal naturally leads to better long-term results than chasing every apparent bargain. The discipline to avoid fool's gold separates successful investors from those who consistently struggle. Develop the skepticism to question why stocks trade cheaply, the analytical skills to distinguish between temporary and permanent problems, and the patience to wait for opportunities where the odds clearly favor success. This approach transforms investing from speculation into a systematic process for building lasting wealth. Part 3. Lessons from Lost Fortunes. Great fortunes have crumbled faster than they were built. Behind every spectacular financial collapse lies a common thread, the dangerous belief that risk can be ignored or wished away. Understanding these failures offers powerful lessons that protect your money and guide better decisions. These stories of lost wealth reveal how even brilliant investors fall prey to hubris, greed, and the seductive promise that this time will be different. By studying their mistakes, you gain the wisdom to avoid similar traps while building lasting wealth through disciplined risk management. The collapse of long-term capital management in 1998 stands as one of the most striking examples of intellectual arrogance meeting market reality. This hedge fund employed Nobel Prize winners and brilliant mathematicians who created sophisticated models to predict market behavior. Their system worked beautifully for years, generating massive returns, while their founders proclaimed they had eliminated risk through mathematical precision. The fund's managers believed their models could capture every possible market outcome. They borrowed enormous amounts of money, sometimes $30 for every dollar they owned, confident that their calculations made failure impossible. When Russian debt markets collapsed unexpectedly, their models failed catastrophically. The fund lost over $4 billion in a matter of months, nearly triggering a global financial crisis. What separated this disaster from ordinary business failure was the complete absence of humility. These brilliant minds forgot that markets contain human emotions, political upheavals, and random events that no model can predict perfectly. They confused mathematical elegance with market certainty, a mistake that destroyed one of the most celebrated investment firms of its era. Consider how different their story might have been if they had acknowledged the limits of their knowledge. A simple rule limiting borrowing to reasonable levels would have preserved their capital even when their models proved wrong. Instead, they bet everything on being right about everything, leaving no room for the unexpected. Gerald Sy Jr. provides another cautionary tale from the go-go years of the 1960s. Known as the first superstar fund manager, Sy built his reputation by buying growth stocks that seemed to rise endlessly. His Manhattan Fund attracted billions from investors who believed he possessed some magical ability to pick winners consistently. Sy's approach ignored basic valuation principles. He bought stocks trading at 50 or even 100 times their earnings, justifying these prices by pointing to rapid growth rates. His strategy worked brilliantly during the bull market of the mid-1960s, making him wealthy and famous. Magazine covers featured his picture alongside headlines about the new era of investing. When the market turned in 1969, reality struck hard. The growth stocks that had made Sy famous fell faster and further than anyone expected. Companies trading at astronomical valuations saw their share prices drop by 80 or 90%. Investors who had trusted Sy with their retirement savings watched decades of careful accumulation disappear. The tragedy was not that Sy made mistakes, but that he ignored the warning signs that his success was built on shaky foundations. He confused a bull market with investing genius, never questioning whether paying any price for growth made sense. A basic understanding of valuation principles would have protected his investors from catastrophic losses. Have you ever been so confident in an investment that you ignored obvious warning signs? This psychological trap catches even experienced investors who let past success cloud their judgment about current risks. The dot-com bubble of the late 1990s created thousands of similar stories on a smaller scale. Day traders quit their jobs to buy internet stocks, convinced they had discovered easy money. Many borrowed against their homes or emptied their retirement TD accounts to chase stocks that rose 10 or 20% daily. Take the story of Derek, a construction worker from Phoenix who turned an initial $10,000 investment into over $200,000 by buying technology stocks. Convinced he had natural talent for picking winners, Derek quit his job and began trading full-time. He borrowed money to increase his buying power and encouraged friends to follow his example. When the bubble burst in 2000, Derek's portfolio collapsed. The stocks he had bought at peak prices fell by 90% or more. Many companies simply disappeared, their shares becoming worthless pieces of paper. Derek lost not only his profits, but also his original savings and the money he had borrowed. He returned to construction work, older but wiser about the difference between a bull market and investing skill. Derek's experience illustrates how easy it becomes to confuse luck with skill during market manias. Rising prices create false confidence, leading investors to take ever larger risks with money they cannot afford to lose. The lesson is not to avoid all risk, but to understand the difference between calculated risks and pure speculation. What Derek needed was a simple rule: never risk money you cannot afford to lose completely. Professional investors understand this principle instinctively, which is why they survive market crashes while amateur speculators disappear. The story of Bill Ackman's investment in Valeant Pharmaceuticals shows how even sophisticated value investors can suffer devastating losses when they abandon their principles. Ackman, known for his rigorous research and activist approach, invested over $1 billion in Valeant, based on the company's promises of growth through acquisitions and price increases. Valeant's business model involved buying drug companies and dramatically raising prices on their medications. The company borrowed heavily to fund acquisitions, claiming it could generate enormous returns by cutting research spending and focusing purely on maximizing revenue from existing drugs. Ackman believed he had found a misunderstood company that the market would eventually recognize as highly valuable. The investment collapsed when investigations revealed questionable accounting practices and a business model that depended on continually raising prices on essential medications. As public outrage grew and regulatory pressure mounted, Valeant's stock price fell from over $200 to under $20. Ackman eventually sold his position at a massive loss, acknowledging he had made serious errors in judgment. This case demonstrates how even experienced investors can be blinded by attractive financial metrics while ignoring fundamental business risks. Ackman got caught up in Valiant's growth story without adequately considering whether the company's practices were sustainable or ethical. His mistake was treating financial engineering as genuine business value creation. The most instructive part of Ackman's experience was his response to the loss. Rather than making excuses or blaming others, he publicly acknowledged his mistakes and explained what he had learned. He recognized that he had violated his own principles by investing in a company whose practices he did not fully understand or approve of morally. Successful investors distinguish themselves not by avoiding all losses, but by learning from their mistakes and adjusting their approach accordingly. Losses become tuition fees for better decision-making, provided you extract the right lessons and apply them consistently. The 2008 financial crisis revealed how supposedly sophisticated institutions had abandoned basic risk management principles. Banks that had survived for over a century disappeared almost overnight because they had borrowed too much money to buy assets they did not properly understand. Consider the fall of Bear Stearns, an investment bank that had operated successfully since 1923. The firm's leaders convinced themselves that housing prices could never fall nationwide, so they borrowed enormous sums to buy mortgage-backed securities. When housing markets collapsed, Bear Stearns found itself owing far more money than its assets were worth. The bank's 85-year history ended in a weekend when it became clear that it could not meet its obligations. Shareholders who had paid over $150 per share just months earlier saw their investment become worthless virtually overnight. The government arranged a fire sale to J.P. Morgan Chase for just $2 per share. Bear Stearns failed because its leaders forgot that no asset class is immune to severe price declines. They concentrated their bets in one sector and used borrowed money to amplify their exposure. When their assumptions proved wrong, they had no safety net to prevent complete collapse. These institutional failures teach individual investors crucial lessons about diversification and leverage. No matter how confident you feel about an investment thesis, concentrating too much money in one area creates unnecessary risk. Similarly, borrowing money to invest amplifies both gains and losses, often beyond what most people can psychologically or financially handle. How much of your total investment portfolio would you be comfortable losing on a single investment? Setting this limit before making decisions helps prevent emotional choices during stressful periods. The key insight from all these failures is that markets are inherently unpredictable in the short term. Mathematical models, past performance, expert opinions, and detailed analysis all have value, but none can eliminate the possibility of being wrong. Successful investing requires building systems that can survive being wrong occasionally while still allowing you to benefit when you are right. This approach means always asking what could go wrong with each investment and whether you can afford those potential losses. It means diversifying across different types of investments and avoiding the temptation to bet everything on your highest conviction ideas. Most importantly, it means maintaining the humility to admit mistakes quickly and learn from them, rather than hoping the market will eventually prove you right. The investors who survive and thrive over decades are not those who avoid all losses, but those who manage their risks carefully and learn continuously from their experiences. They understand that preserving capital is the foundation of long-term wealth building, making steady progress more important than spectacular gains that could disappear just as quickly. Building this mindset requires viewing each investment decision through the lens of what you could lose rather than what you might gain. This perspective naturally leads to more conservative position sizing, better diversification, and the psychological preparation needed to handle inevitable setbacks without panic or despair. Part 4. Building your fortress. Smart investors know that protecting wealth matters more than chasing quick gains. This section teaches you how to build multiple layers of defense around your investments, much like constructing a fortress with walls, moats, and watchtowers. You will learn practical techniques for spreading risk, sizing positions correctly, and creating personal rules that keep your money safe during market storms. These defensive strategies separate successful long-term investors from those who lose everything when markets turn ugly. By the end, you will have a clear blueprint for protecting your investment capital while still capturing meaningful returns. Think of your investment portfolio as a medieval fortress under constant threat of attack. Just as castle builders never relied on a single wall for protection, smart investors never depend on one strategy to safeguard their wealth. They build multiple defensive layers that work together to protect against different types of market dangers. The first wall of your fortress is diversification, but not the kind most people think they understand. Many investors believe they are diversified because they own 20 different technology stocks or spread their money across various mutual funds. This creates a false sense of security. Real diversification means owning assets that behave differently during various market conditions. Consider Emma, a nurse who learned this lesson the hard way. She thought she was diversified because she owned stocks in 5 different companies. But all 5 were retail companies that sold luxury goods. When the economy slowed down, people stopped buying expensive items, and all 5 stocks fell together. Emma lost 60% of her portfolio in 6 months because her diversification was an illusion. Smart diversification spreads risk across different types of businesses, industries, and even countries. You might own a utility company that provides steady dividends, a consumer goods company that sells products people need regardless of economic conditions, and a technology company positioned for long-term growth. When one area struggles, others can continue performing well. The second defensive layer involves position sizing, which determines how much money you risk on each investment. This might be the most important skill that separates successful investors from those who blow up their accounts. The rule is simple. Never risk so much on a single investment that losing it would seriously damage your financial future. Professional investors often follow the 1% rule for risky investments. This means they never risk more than 1% of their total portfolio on any single speculative bet. For safer, well-researched investments, they might risk up to 5%. The key is that even if their worst investment goes to zero, they can continue investing and eventually recover. James, a teacher, used to put 20% of his savings into individual stock picks based on tips from friends. When 3 of these sure things failed within 2 years, he lost over half his retirement money. After learning about position sizing, James now limits each stock investment to 3% of his portfolio. This approach means he can be wrong many times and still preserve his wealth for the long term. What percentage of your total investment money would you be comfortable losing on your next investment choice? This question forces you to think about position sizing before emotions take over. The third defensive layer consists of quality standards that act like guards at your fortress gates. These standards determine which investments deserve your money and which should be rejected regardless of their apparent cheapness. Quality standards prevent you from buying companies with weak balance sheets, declining businesses, or dishonest management teams. Successful investors often create written checklists that every potential investment must pass. These might include requirements like consistent profitability over 10 years, debt levels below a certain percentage of assets, and market-leading positions in growing industries. Companies that fail these tests get rejected immediately, no matter how low their stock prices fall. The fourth layer involves cash reserves, which serve as your fortress's emergency supplies. Many investors feel pressured to have all their money invested at all times, fearing they will miss opportunities. This mindset can be dangerous during market downturns when the best opportunities appear, but most investors have no cash available to take advantage. Experienced investors typically keep 10 to 20% of their portfolios in cash or short-term bonds. This cash serves 2 purposes. First, it provides flexibility to buy excellent companies when their stock prices fall during market panics. Second, it offers psychological comfort during volatile periods, making it easier to hold on to investments when prices fluctuate wildly. The fifth defensive layer consists of predetermined exit rules that remove emotion from difficult decisions. These rules specify exactly when you will sell an investment, whether because it has become overvalued, the company's fundamentals have deteriorated, or you made an error in your original analysis. Without clear exit rules, investors often hold losing investments too long, hoping they will recover, while selling winning investments too quickly to lock in profits. This behavior destroys long-term returns and prevents wealth building. Lisa, a small business owner, created simple exit rules after watching her first stock investment fall from $50 to $15 while she kept hoping for a recovery. Her rules now state that she will sell any investment that falls more than 30% from her purchase price, unless she can identify specific reasons why the decline is temporary and the company's long-term prospects remain strong. How would you know when it is time to sell an investment that is not performing as expected? Having a clear answer before you buy prevents costly emotional decisions later. The final defensive layer involves continuous learning and adaptation. Markets change, new risks emerge, and even the best defensive strategies need updates. Smart investors regularly review their approaches, study their mistakes, and adjust their methods based on new experiences. They also stay informed about broader economic trends that could affect their investments. This does not mean following every market prediction or economic forecast, but rather understanding major forces like interest rate changes, inflation trends, and regulatory shifts that could impact entire industries. Building your investment fortress requires patience and discipline. Each defensive layer takes time to construct and maintain, but together they create a robust system that can protect your wealth through various market conditions. The goal is not to eliminate all investment risk, which is impossible, but to manage risks so effectively that you can invest with confidence and sleep well at night. Remember that even the strongest fortress requires regular maintenance. Review your defensive strategies periodically, especially after major market events or changes in your personal financial situation. What worked during calm markets might need adjustment during turbulent times. Your investment fortress should reflect your personal situation and risk tolerance. A young investor with decades until retirement can build different defenses than someone approaching retirement who needs more conservative protection. The key is creating multiple layers of defense that work together to protect your financial future while still allowing your wealth to grow over time. Chapter 3, The Art of the Deal, Buying with Confidence. Part 1, The Price is Right. Smart investors know that price matters more than popularity. The difference between winning and losing in the stock market often comes down to one simple principle: paying the right price for what you get. This section reveals how to spot genuine bargains, avoid costly mistakes, and develop the patience to wait for truly attractive opportunities. By mastering these valuation skills, you'll transform from someone who buys stocks to someone who buys businesses at compelling prices. The techniques covered here have helped countless investors build wealth by focusing on value rather than hype. Picture Emma walking through a weekend garage sale. She spots a beautiful antique lamp marked at $5. Her neighbor Dave sees the same lamp and thinks it looks nice. But Emma knows antiques. She recognizes the maker's mark and realizes this lamp could sell for $200 at an auction house. Dave might buy the lamp because it looks pretty. Emma buys it because she understands its true worth. This same principle drives successful stock investing. The stock market is like a giant garage sale where prices change every day based on emotions, news, and crowd behavior. Sometimes a stock worth $50 trades for $30 because investors are worried about short-term problems. Other times, a stock worth $20 trades for $40 because everyone wants to own it. The key question becomes, how do you determine what a business is really worth? Think of it like buying a small grocery store in your neighborhood. You wouldn't just look at the asking price. You'd want to know how much money the store makes each year, how much debt it carries, what assets it owns, and whether its profits are growing or shrinking. Carlos, a retired teacher, learned this lesson the hard way. In 2000, he bought shares of a popular internet company trading at 100 times its annual earnings. The stock seemed exciting because everyone was talking about it. But when the excitement faded, Carlos discovered he had paid $100 for something worth maybe $10. The company had no real profits and mountains of debt. What separates smart buyers from hopeful speculators? Smart buyers focus on three simple numbers: what the company earns, what it owns, and what it owes. These numbers tell the real story behind the stock price excitement. Start with earnings. A profitable company that makes $5 per share each year might be worth $50 to $75 per share, depending on how stable and growing those earnings are. If you can buy that same stock for $30, you've found a potential bargain. If it costs $90, you're probably paying too much. Think about assets next. Some companies own valuable things like real estate, equipment, or cash that aren't reflected in their stock price. Maria, a small business owner, bought shares of a struggling retailer trading for $8 per share. She noticed the company owned prime real estate worth $15 per share. Even if the retail business failed, she figured the property value protected her investment. Don't forget about debt. A company with huge debt payments is like a person with massive credit card bills. Even if they make good money, most of it goes to creditors instead of shareholders. Always subtract what a company owes from what it owns to get a clearer picture. The margin of safety concept acts like a financial seatbelt. Instead of paying exactly what you think something is worth, you demand a discount. If you believe a stock is worth $50, you might wait to buy it at $35 or less. This 25% discount protects you if your analysis is wrong or if unexpected problems arise. Consider how this played out for Robert, a mechanic who studied businesses in his spare time. He identified a small manufacturing company worth approximately $40 per share based on its steady profits and strong balance sheet. Instead of buying immediately, Robert waited patiently for 18 months. When a temporary supply chain problem scared other investors, the stock dropped to $26. Robert bought shares and doubled his money over the next 3 years as the company recovered. How do you develop the patience to wait for such opportunities? Remember that the stock market serves you, not the other way around. You don't have to buy anything today, tomorrow, or next month. The best opportunities often require waiting for the right pitch, just like a baseball player waiting for the perfect ball to hit. The price-to-earnings ratio offers a simple starting point for valuation. This number tells you how many years of current profits you're paying for when you buy a stock. A stock trading at 15 times earnings means you're paying 15 years' worth of current profits. Historical data suggests that buying stocks at low price-to-earnings ratios generally produces better long-term returns than buying expensive ones. But earnings alone don't tell the complete story. Some companies report high earnings that aren't sustainable, while others show temporarily low earnings that don't reflect their true potential. This is where understanding the business becomes crucial. What makes a business worth paying for? Look for companies with competitive advantages that protect their profits. These might include strong brand names, unique products, efficient operations, or loyal customers. A company that can raise prices without losing customers usually has some form of competitive protection. Janet, a nurse practitioner, found success buying shares of a regional bank trading at a low price relative to its book value. She researched the bank's loan portfolio, management quality, and local market position. While other investors worried about banking regulations, Janet recognized that this particular bank had conservative lending practices and served a growing community. Her patience paid off as the stock tripled over 5 years. The concept of intrinsic value guides professional investors in making these judgments. Intrinsic value represents what a rational buyer would pay for the entire business if it weren't publicly traded. This involves estimating future cash flows, growth prospects, and risks. You don't need complex formulas to apply this thinking. Ask yourself, if I could buy this entire company, would I be happy earning its current profits on my investment? Would I expect these profits to grow, stay flat, or decline? How confident am I in these expectations? Sometimes the best deals hide in plain sight during market downturns. When fear dominates headlines, quality companies often trade at discounts to their intrinsic value. This creates opportunities for patient investors who can think independently of the crowd. Do you find yourself drawn to stocks that have already risen dramatically in price? This natural tendency leads many investors astray. Popular stocks often become expensive stocks. The companies everyone loves to discuss at dinner parties rarely offer the best bargains. Price discipline requires saying no to most opportunities. For every stock you buy, you might reject dozens of others that don't meet your value criteria. This selectivity isn't being picky, it's being professional. The best value investors develop a systematic approach to valuation that removes emotions from their decisions. They might create simple checklists covering earnings quality, debt levels, competitive position, and valuation metrics. When a potential investment fails to meet their standards, they move on without regret. Learning to recognize bargains takes practice, but the principles remain constant. Focus on what you're getting for your money, demand a margin of safety, and maintain the discipline to wait for attractive opportunities. The stock market will always offer new chances to those who know how to spot them. Part 2. When to walk away. Walking away from a potential investment might feel like missing out on easy money, but the most successful investors know that learning to say no is their greatest skill. This section reveals the mental discipline required to pass on opportunities that don't meet strict value standards, showing how emotional restraint and unwavering principles separate profitable investors from those who chase every shiny opportunity. Through real examples and practical frameworks, you'll discover why the best investors often make their biggest gains by refusing to buy stocks that everyone else wants. When Elena first started investing, she bought everything that looked remotely promising. A tech stock with good news? She bought it. A company with rising sales? She was in. Within 6 months, her portfolio looked like a garage sale of random investments, and her returns were disappointing. The turning point came when her mentor asked her a simple question: "What's your investment criteria?" Elena realized she didn't have any clear standards. This scenario plays out thousands of times in the investing world. People jump into investments without clear criteria, then wonder why their results are mediocre. The solution lies in developing strict investment standards and sticking to them, no matter how attractive an opportunity appears. Consider the experience of Marcus, a value investor who spent 3 years analyzing a popular restaurant chain. The company had strong brand recognition, growing locations, and enthusiastic customers. The stock price had risen steadily for 2 years. Friends kept asking why he hadn't bought shares yet. Marcus had one simple answer: the price was too high relative to the company's actual earnings and assets. When the stock price fell by 40% during a market downturn, Marcus finally bought shares. The company's fundamental business hadn't changed, but the price now offered the margin of safety he required. 2 years later, his investment had doubled, while those who bought at higher prices were still waiting to break even. The discipline to walk away requires a clear framework for decision-making. Successful value investors typically establish specific criteria before evaluating any investment. These might include requirements for debt levels, profit margins, return on equity, and most importantly, the price relative to intrinsic value. Take the case of Rita, who developed a simple checklist after losing money on several impulsive purchases. Her criteria included: the company must be profitable for at least 5 consecutive years, debt must be less than 30% of total assets, and the stock price must trade at less than 15 times earnings. She also required understanding the business well enough to explain it to a friend in simple terms. When Rita found a seemingly attractive biotech company, she was tempted by analyst predictions of huge growth. However, the company failed her profitability test, having lost money for 3 straight years. Despite the exciting potential, she walked away. 6 months later, the company's experimental drug failed trials, and the stock price collapsed by 70%. How do you resist the fear of missing out when everyone else seems to be making money on investments you've rejected? The answer lies in understanding that every investment decision is a trade-off between risk and reward. Professional investors often use what they call the circle of competence concept. This means only investing in businesses and industries they truly understand. When Tom, a retired teacher, was offered a chance to invest in a promising cryptocurrency startup, he declined. While he understood the technology might be revolutionary, he couldn't evaluate the business fundamentals or competitive risks. By staying within his circle of competence, Tom avoided the 80% decline that followed when the cryptocurrency market crashed. The emotional challenge of walking away becomes easier when you focus on preservation of capital rather than potential gains. Every dollar you don't lose on a poor investment is a dollar available for a better opportunity. This mindset shift transforms saying no from a negative action into a positive strategy. Consider how professional fund managers approach this challenge. They often review hundreds of potential investments but might only purchase 10 to 15 stocks per year. This selectivity isn't laziness. It's recognition that finding truly undervalued securities requires patience and discipline. One effective technique is maintaining a watch list of interesting companies that don't currently meet your criteria. Alex, a part-time investor, tracks about 20 companies he'd like to own someday. He monitors their financial performance and stock prices, waiting for the right combination of business quality and attractive valuation. This approach keeps him engaged without forcing premature decisions. The hardest part of walking away often comes when you've already spent significant time researching an investment. This sunk cost mentality tricks people into making purchases they know aren't ideal. Remember that research time is never wasted if it prevents a poor investment decision. Sometimes the best opportunities arise precisely because other investors lack the discipline to walk away from marginal situations. When markets become euphoric, disciplined investors step aside and wait. When fear dominates and good companies trade at unreasonable discounts, these same investors have cash available to buy. The practice of walking away becomes easier over time as you witness the consequences of both patient and impulsive investing. Each avoided mistake strengthens your confidence in your criteria and your willingness to wait for better opportunities. What criteria will you establish to guide your investment decisions? And how will you resist the temptation to compromise these standards when faced with an appealing but imperfect opportunity? Part 3. Special situations. The hidden doorways. Special situations represent some of the most rewarding opportunities in value investing, yet most investors miss them entirely. These events create temporary confusion in the market, causing stocks to trade at prices that make little sense. While other investors avoid complexity, value investors who understand these situations often find their best returns hiding in plain sight. Companies going through major changes like spin-offs, mergers, or restructurings frequently offer exceptional value to those willing to do the homework. The beauty of special situations lies in their temporary nature. Markets dislike uncertainty, creating selling pressure that pushes prices below intrinsic value. Smart investors recognize these moments as opportunities rather than problems. Consider the story of Rachel, a seasoned investor who noticed something interesting happening at a large conglomerate called Megacorp. The company announced plans to spin off its struggling retail division into a separate public company. Most investors viewed this as bad news, worried about owning shares in a weak business. Megacorp's stock price dropped as shareholders anticipated receiving shares in the new retail company they didn't want. Rachel saw opportunity where others saw problems. She studied the retail division carefully and discovered something remarkable. While the division struggled as part of Megacorp, it owned valuable real estate in prime locations. The company's problems stemmed from poor management decisions, not fundamental business issues. After the spin-off, new management could either improve operations or sell the real estate for significant profits. What made this situation special was the forced selling. Large institutional investors often have rules preventing them from owning small companies. When Megacorp spun off the retail division, these institutions would automatically sell their shares regardless of value. This created artificial downward pressure on the stock price. Rachel calculated that the retail division's real estate alone was worth more than the entire market value after the spin-off. She bought shares aggressively while others were selling. Within 2 years, new management sold several properties and improved operations. The stock price increased by 300%. Restructuring situations offer similar opportunities. When companies face financial difficulties, markets often assume the worst-case scenario. However, businesses with valuable assets or strong market positions can emerge stronger after restructuring their debts and operations. Take the example of David, who studied a manufacturing company called Steelworks during its bankruptcy proceedings. The company had borrowed heavily to expand operations just before a recession hit. While bankruptcy scared most investors away, David recognized that Steelworks owned efficient modern factories and maintained strong relationships with major customers. The bankruptcy process allowed Steelworks to eliminate expensive debt and close unprofitable facilities. David purchased bonds that would convert to stock ownership after the company emerged from bankruptcy. His analysis showed that the streamlined company could generate substantial cash flow once economic conditions improved. Have you ever considered how temporary problems might create permanent opportunities for patient investors? The key to success in special situations is understanding the specific mechanics of each event. Spin-offs create new independent companies that often trade at discounts because shareholders receive them without choosing to buy them. Merger arbitrage opportunities arise when markets doubt whether announced deals will actually close. Bankruptcy situations can reward investors who accurately assess asset values and recovery prospects. Companies emerging from difficult periods often become more efficient and focused. Management teams learn hard lessons about capital allocation and operational efficiency. These improvements can create lasting, competitive advantages that drive superior returns for years. Special situations require more research than typical stock purchases, but they often provide better risk-adjusted returns. The complexity that scares away casual investors creates opportunity for those willing to understand the details. Marcus discovered this principle while researching a telecommunications company going through a complex restructuring. The company had valuable wireless spectrum licenses, but struggled with debt payments. Most investors avoided the situation because they found the legal proceedings confusing. Marcus spent weeks studying court documents and regulatory filings. He learned that the company's spectrum licenses were worth far more than its debts. The restructuring would eliminate most obligations while preserving the valuable assets. He invested when the stock traded at a fraction of the spectrum's estimated value. Consider how often you avoid investments simply because they seem complicated, rather than analyzing whether complexity creates opportunity. The patience required for special situations often extends the typical investment timeline. These events can take months or years to fully develop. However, the extended time frame also provides additional margin of safety, as there's more time for value to be recognized. Successful special situation investing requires developing expertise in specific areas. Some investors focus on merger arbitrage, others specialize in spin-offs or distressed situations. Building knowledge in one area allows investors to recognize patterns and evaluate opportunities more quickly. Risk management becomes particularly important in special situations. Unlike regular stock investments, these situations can have binary outcomes. A merger either closes or it doesn't. A bankruptcy restructuring either succeeds or fails. Diversification across multiple special situations helps manage these concentrated risks. The most important skill for special situation investing is learning to think independently. Markets often misprice these opportunities because conventional wisdom suggests avoiding complexity. Investors who can look past surface-level concerns and analyze underlying fundamentals often find exceptional values. Special situations remind us that the best opportunities rarely come with clear labels or obvious appeal. They require work, patience, and willingness to act when others hesitate. These hidden doorways lead to some of value investing's greatest success stories, waiting for investors brave enough to walk through them. Part 4. Stories from the Bargain Bin. The biggest fortunes in stock market history weren't built by chasing the latest hot stock or following crowd trends. They came from investors who discovered incredible bargains when everyone else was running away. These stories reveal how ordinary people used simple value investing principles to achieve extraordinary results. From buying banks during panic to finding gold in bankruptcy courts, these tales show that patient research and contrarian thinking can lead to life-changing wealth. The best part? These opportunities still exist today for those willing to look where others won't. When Patricia Chen walked into her office on October 19, 1987, She watched her computer screen flash red as the Dow Jones dropped over 500 points in a single day. While her colleagues panicked and sold everything, Patricia did something different. She pulled out her notebook filled with companies she had been tracking for months. These were solid businesses with strong balance sheets that she couldn't afford at their previous prices. Now, with fear gripping the market, these same companies were trading at 40% discounts. Patricia focused on Regional Bancorp, a small community bank she had studied extensively. The bank had no exposure to risky loans, maintained strong capital ratios, and served a growing suburban market. Before the crash, it traded at 15 times earnings. On Black Monday, panic selling pushed it down to 8 times earnings. Patricia bought 1,000 shares at $24 each. Within 2 years, as markets recovered and people realized the bank's fundamentals remained strong, the stock climbed to $68. Her $24,000 investment became worth $68,000. The key to Patricia's success wasn't luck or timing the market perfectly. She had done her homework months before the opportunity arrived. She knew what these companies were worth when others only saw falling prices. This preparation allowed her to act while others froze in fear. Consider how David Kumar found his fortune in what others saw as trash. In 2008, as the financial crisis unfolded, energy companies became toxic investments. Nobody wanted to touch anything related to oil or gas. David, working as an accountant, spent his evenings analyzing energy companies that had been beaten down beyond reason. He discovered Prairie Energy, a small oil and gas company trading at $3 per share. The company owned proven reserves worth $15 per share based on conservative oil price estimates. Even more interesting, Prairie had no debt and $2 per share in cash sitting in the bank. Essentially, investors could buy $17 worth of assets for $3. The market was giving away dollar bills for quarters. David invested $30,000 of his savings in Prairie Energy stock. The investment required patience as the stock continued falling to $2.50 before slowly recovering. By 2011, as energy markets stabilized and oil prices recovered, Prairie Energy was acquired by a larger company for $22 per share. David's investment grew from $30,000 to over $175,000. What separated David from other investors was his willingness to look at companies everyone else avoided. While others saw only crisis and uncertainty, David saw mathematical opportunities where the downside was limited, but upside was enormous. Have you ever walked past a clearance rack and found designer clothes at 80% off simply because they were last season's style? The stock market creates similar situations regularly, but instead of clothes, savvy investors find quality companies at deep discounts. Maria Santos experienced this during the dot-com crash of 2000. While technology stocks collapsed and investors fled anything related to the internet, Maria noticed that traditional retail companies were also getting hammered unfairly. Many of these businesses had nothing to do with the internet bubble, but were caught in the general selling panic. She studied Hometown Furniture, a regional furniture chain that had been profitable for 30 consecutive years. The company owned its store locations outright, had minimal debt, and generated consistent cash flow. Before the crash, it traded at $45 per share. During the panic, it fell to $12 per share, even though the business fundamentals hadn't changed. Maria calculated that the company's real estate alone was worth $25 per share, not counting the profitable furniture business. She bought 500 shares at $12 each, investing $6,000. As markets recovered and investors regained their senses, they realized Hometown Furniture was still the same solid business. The stock gradually climbed back to $38 over the next 3 years, turning Maria's $6,000 into $19,000. The pattern in these success stories reveals a fundamental truth about markets. Prices often swing far beyond what business fundamentals justify. During periods of extreme fear or greed, quality companies can trade at prices that make no economic sense. These disconnects create opportunities for prepared investors. Robert Kim discovered this principle during the European debt crisis of 2011. News headlines screamed about potential European bank failures and currency collapse. American investors started selling any company with European exposure, regardless of the actual business impact. Robert noticed that Global Consumer Products, an American company that made household goods, had dropped 60% simply because 30% of its sales came from Europe. The company's European operations were actually profitable and growing. Even if European sales disappeared entirely, the remaining business was worth more than the current stock price. Robert bought shares at $18 each. As the European crisis proved less severe than feared, the stock recovered to $42 within 18 months. These stories share common elements that any investor can apply. First, successful bargain hunters do their research before opportunities appear. They maintain lists of quality companies they want to own at the right price. When market panic strikes, they're ready to act while others struggle to make sense of the chaos. Second, they focus on companies with strong fundamentals that can survive temporary difficulties. They avoid businesses with excessive debt, declining industries, or management problems. The goal is finding quality companies at quantity prices, not buying junk hoping for miracles. Third, they think independently and act when others won't. The best bargains appear when conventional wisdom says to avoid entire industries or market sectors. Successful investors question whether the fear is justified by actual business fundamentals or driven by emotion and momentum. What areas of today's market might be creating similar opportunities for patient investors willing to research and wait? The principles that created wealth for Patricia, David, Maria, and Robert remain valid today. Markets still overreact, fear still creates opportunities, and quality businesses still get mispriced during periods of uncertainty. The bargain bin approach requires discipline to wait for truly exceptional opportunities rather than settling for merely cheap stocks. It demands courage to buy when others are selling and patience to hold until value is recognized. Most importantly, it requires the wisdom to know the difference between a temporary setback and a permanent impairment. These stories prove that remarkable bargains still exist for investors willing to look beyond the obvious and think for themselves. The next great opportunity might be hiding in plain sight, waiting for someone with the preparation and courage to recognize its potential. Chapter 4. The Long Game. Growing Your Wealth. Part 1. The magic of compounding money has an incredible ability to work for you while you sleep, shop, or spend time with family. This phenomenon, known as compounding, transforms small amounts into substantial wealth over time. When your investments earn returns, and those returns generate their own returns, the effect becomes remarkable. Understanding how compounding works changes everything about how you view time, patience, and wealth building. This section explores real stories of ordinary people who harness this power, practical strategies for maximizing compound growth, and why starting early creates advantages that can never be replicated later in life. When Emma started working at 22, she decided to invest $200 monthly in a diversified stock portfolio. Her friend Jake waited until he was 32 to begin investing, contributing $400 monthly. Both invested for 35 years with similar returns. Despite Jake investing twice as much each month, Emma ended up with significantly more money. The 10-year head start gave Emma's money more time to compound, creating wealth that Jake's higher contributions could never match. This story illustrates the mathematical magic behind compounding. When you invest money, it earns returns. Those returns then earn their own returns. This process creates exponential growth rather than linear growth. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and grows larger. The longer the hill, the bigger the snowball becomes. Consider Maria, who invested $5,000 at age 25 and never added another dollar. By retirement at 65, assuming a 7% annual return, her single investment grew to over $149,000. Meanwhile, her brother Carlos waited until 35 to start investing, but contributed $5,000 every year for 30 years, totaling $150,000 in contributions. His final balance reached approximately $472,000. While Carlos ended up with more money due to his larger total contributions, Maria's return on investment was extraordinary, given her single $5,000 input. What makes compounding so powerful in the stock market? When you buy shares of quality companies at reasonable prices, you participate in their long-term growth. These companies reinvest their profits, expand operations, and increase their value over time. As their stock prices rise and they pay dividends, your investment grows. When you reinvest those dividends to buy more shares, you own more pieces of growing businesses. Have you ever calculated how much your current monthly expenses might cost in 20 or 30 years? This exercise often motivates people to start investing sooner rather than later. The key to successful compounding lies in consistency and patience. Regular investing, even small amounts, creates momentum. When markets decline, your regular investments buy more shares at lower prices. When markets rise, those additional shares participate in the growth. This approach, called dollar-cost averaging, smooths out market volatility while building wealth steadily. Tom discovered this principle during the 2008 financial crisis. While others panicked and sold their investments, Tom continued his monthly $300 investment routine. The market crash allowed him to buy shares at deeply discounted prices. When markets recovered, those shares purchased during the downturn generated exceptional returns. His disciplined approach during scary times accelerated his wealth building significantly. Time remains the most critical factor in compounding success. Starting at 25 versus 35 provides 10 additional years of growth. Those extra years at the beginning create more impact than larger contributions later. This happens because early investments have more time to double, redouble, and continue growing. The rule of 72 provides a simple way to understand doubling time. Divide 72 by your expected annual return to estimate how long your money takes to double. With a 7% return, your money doubles approximately every 10 years. A $10,000 investment becomes $20,000 in 10, $40,000 in 20 years, and $80,000 in 30 years, assuming no additional contributions. Quality companies often increase their dividends annually, creating compounding within compounding. When Linda bought shares of established companies with growing dividends, she experienced this double effect. Not only did her stock prices increase over time, but her dividend income grew each year. She reinvested these growing dividends to purchase more shares, which then generated even more dividends. This dividend growth compounding becomes particularly powerful over decades. A stock yielding 3% today might yield 6% or more on your original investment after 15 years of annual dividend increases. Your income grows while your principal appreciates, creating multiple wealth-building engines working simultaneously. How might your life change if your investments generated enough passive income to cover your basic expenses? This question helps clarify long-term financial goals. Inflation makes compounding even more valuable. While prices rise over time, your growing investments help maintain and increase your purchasing power. Money sitting in low-yield savings accounts loses value to inflation, but well-invested money typically grows faster than inflation rates. The most successful compounding stories involve ordinary people making consistent choices over long periods. They start early, invest regularly, choose quality investments, and resist the temptation to interrupt the process. These individuals understand that wealth building resembles growing an oak tree rather than harvesting quick crops. Your compounding journey begins with the first dollar invested and continues with every subsequent contribution. The magic happens not through complex strategies or perfect timing, but through the simple act of starting and staying consistent. Time transforms modest beginnings into remarkable endings, making patient investors the ultimate winners in the wealth-building game. Part 2. Staying the course. The journey from understanding compounding to actually living through market storms tests every investor's resolve. While compound growth works its magic over decades, the path forward rarely follows a straight line. Markets rise and fall like ocean tides, carrying emotions that can overwhelm even the most logical investment plans. This section explores the mental battles investors face and provides proven strategies for staying committed to value principles when everything around you seems uncertain. Through real experiences of those who weathered major downturns, you'll discover how discipline becomes your greatest asset and learn practical methods for maintaining course when fear and doubt creep in. The year 2008 taught investors harsh lessons about staying committed. When global markets crashed, panic spread faster than wildfire. Companies that seemed rock solid just months earlier saw their stock prices cut in half overnight. News channels filled with doom and gloom, predicting the end of capitalism as we knew it. Many investors abandoned their long-term strategies and sold everything, locking in massive losses they would never recover. Consider the story of Robert, a teacher from Ohio who had spent 15 years building a portfolio of quality companies trading below their true worth. When the financial crisis hit, his portfolio dropped by 40% in just 6 months. His friends urged him to sell before losing everything. His brother called daily, warning that the economy would never recover. The financial media painted pictures of permanent economic collapse. Robert faced the same psychological pressure that breaks most investors. Fear whispered that this time was different, that his careful analysis meant nothing in a world gone mad. Greed tempted him to abandon his strategy and chase quick profits in gold or government bonds. Impatience made him question why he had ever believed in patient value investing when day traders seemed to make money faster. Yet Robert had prepared for this moment without knowing it. Years earlier, he had studied the stories of great investors who survived previous crashes. He understood that market downturns were not anomalies, but normal parts of the investing cycle. When panic peaked, Robert did something remarkable. He bought more shares of the same quality companies he already owned, now available at even deeper discounts. What gives you the strength to buy when everyone else is selling? The answer lies in understanding that market prices often disconnect from business reality during extreme periods. Great companies continue operating, serving customers, and generating profits even when their stock prices collapse. The gap between price and value creates opportunities for patient investors willing to act against the crowd. The psychological challenges extend beyond major crashes. Daily market movements create constant noise that can derail long-term thinking. Emma, a nurse from California, discovered this when she started checking her portfolio multiple times each day. Every small decline made her question her investment choices. Every temporary gain made her consider selling to lock in profits. The constant emotional roller coaster exhausted her and nearly drove her away from investing altogether. Emma learned to manage these psychological traps by implementing simple but powerful rules. She limited herself to checking portfolio values once per month. She stopped watching financial news programs that turned minor market movements into major events. Most importantly, she focused on the businesses she owned rather than their daily stock prices. Building mental resilience requires understanding the difference between temporary setbacks and permanent problems. When one of your companies reports disappointing quarterly earnings, the stock price might drop 20% in a single day. Your first instinct might be to sell before further declines. However, successful value investors ask different questions. Has the business model fundamentally changed? Are customers abandoning the product permanently? Has management made decisions that threaten long-term prospects? Marcus, an engineer from Texas, faced exactly this situation when his largest holding, a well-established retailer, missed earnings expectations for 2 consecutive quarters. The stock price fell from $40 to $25, wiping out 3 years of gains. Instead of panicking, Marcus analyzed the situation methodically. He discovered that the earnings decline resulted from temporary supply chain disruptions rather than permanent competitive disadvantages. The company's strong brand, loyal customer base, and excellent management team remained intact. How do you distinguish between temporary problems and permanent damage? Start by examining the factors that originally attracted you to the investment. If those fundamental strengths remain unchanged, temporary setbacks often create buying opportunities rather than selling signals. Market overreactions frequently punish good companies for short-term problems that management can solve. The media amplifies psychological pressure by sensationalizing normal market behavior. Financial news networks need viewers, so they present every market movement as urgent breaking news. Headlines scream about market crashes when indices drop 3%. Commentators debate whether bull markets have ended after single bad days. This constant drama makes normal volatility seem like crisis. Developing immunity to media hysteria becomes essential for long-term success. Lisa, a graphic designer from Florida, solved this problem by creating an information diet. She canceled her financial magazine subscriptions and stopped visiting investment websites daily. Instead, she read annual reports from her companies and focused on understanding their business progress. This simple change reduced her stress levels dramatically and improved her investment decisions. Creating structured decision-making processes helps overcome emotional impulses during difficult periods. Before making any major portfolio changes, write down your reasoning and wait 24 hours before acting. This cooling-off period prevents panic-driven mistakes that can damage long-term returns. Keep a written record of why you bought each investment, including your assessment of the company's strengths and your target holding period. The power of written plans becomes clear during market turbulence. When emotions run high, returning to your original analysis helps maintain perspective. If your research suggested holding a stock for 10 years, temporary price declines in year 3 shouldn't change that timeline unless fundamental business conditions have deteriorated permanently. Physical strategies can support mental discipline during challenging periods. Regular exercise reduces stress and improves decision-making capacity. Meditation or deep breathing exercises help maintain calm during market storms. Some investors find that gardening or other long-term hobbies reinforce the patience required for successful investing. Building a support network of like-minded investors provides emotional stability when others question your approach. Join investment clubs focused on value principles rather than day trading strategies. Find mentors who have successfully navigated previous market cycles. Surround yourself with people who understand that temporary volatility creates opportunities rather than reasons to panic. What matters most during difficult periods is remembering why you chose value investing originally. Quality companies purchased at reasonable prices tend to compound wealth over time, regardless of short-term market movements. The strategy works not because it avoids volatility, but because it harnesses market overreactions to create superior long-term returns. Your ability to stay the course ultimately determines your investment success more than your stock-picking skills or market timing abilities. Markets will test your resolve repeatedly throughout your investing journey. Those who maintain discipline during these tests position themselves to benefit when rationality returns and prices reflect true business values once again. Part 3. Learning from mistakes. Mistakes are not failures in investing. They are expensive lessons that can transform average investors into exceptional ones. Every successful value investor has a collection of investment blunders that shape their approach and sharpen their judgment. The key difference between those who succeed and those who quit lies not in avoiding mistakes, but in how they respond to them. When you approach investing with curiosity rather than shame about your errors, you develop the resilience needed for long-term wealth building. Think of your investment mistakes as tuition payments to the greatest business school in the world. Consider the story of Elena, who bought shares in a restaurant chain in 2019 because she loved eating there. The food was delicious, the service was excellent, and the locations were always busy. She felt confident this was a winning investment. However, she never examined the financial statements. When the pandemic hit, she discovered the company had borrowed heavily to expand rapidly. The debt burden crushed the business, and Elena lost 60% of her investment. The painful lesson taught her to separate her emotions as a customer from her analysis as an investor. Elena's mistake illustrates a common trap. Many investors confuse familiarity with understanding. Just because you use a product or service doesn't mean the company is a good investment. The numbers tell the real story. A company might have great products but terrible finances. After her restaurant chain disaster, Elena learned to analyze debt levels, cash flow, and profit margins before making any investment decision. Another frequent error involves timing the market. Marcus thought he was smart when he sold all his value stocks in March 2020 as markets crashed. He planned to buy them back when they hit bottom. The problem was that he never knew when the bottom would arrive. As markets recovered faster than expected, Marcus watched his former holdings soar, while his cash earned nothing. By the time he finally reinvested 6 months later, he had missed significant gains. This experience taught him that time in the market beats timing the market. Have you ever made an investment decision based on a hot tip or recent news headline? This represents another classic mistake. Rosa heard her brother-in-law praising a technology stock at a family dinner. The company had just announced a breakthrough product, and everyone seemed excited. Rosa bought shares the next day without researching the business. 3 months later, she learned that the product faced regulatory delays, and the stock price fell sharply. Her lesson was clear: never invest based on someone else's enthusiasm without doing your own homework. The most successful investors maintain what experts call a learning journal. They write down why they bought each stock, what they expected to happen, and what actually occurred. When investments go wrong, they analyze what signals they missed and what assumptions proved false. This practice transforms mistakes from painful experiences into valuable education. Warren Buffett once said his biggest mistake was not buying enough shares of excellent companies when he found them. Even legendary investors make errors, but they use these experiences to refine their approach. Buffett learned to focus more on business quality and less on getting the absolute lowest price. What specific mistake have you made that taught you the most about investing? The answer to this question reveals your growth as an investor. Those who can articulate their biggest lessons demonstrate the self-awareness needed for long-term success. Building resilience requires accepting that mistakes are inevitable. The market will humble every investor eventually. Companies you believe are solid will disappoint. Economic conditions will change unexpectedly. Your analysis will sometimes be wrong. This doesn't mean you should avoid investing. It means you should invest with appropriate humility and preparation. The best defense against costly mistakes is position sizing. Never put more than 5% of your portfolio in any single stock. This way, even a complete loss won't devastate your finances. Diversification across different industries and company sizes further reduces risk. When one investment goes wrong, others can offset the damage. Successful value investors also develop emotional discipline through experience. Each mistake teaches them to separate their ego from their portfolio. When a stock falls, they ask whether the business fundamentals have changed or if the market is simply being irrational. If the business remains solid, they might buy more shares at lower prices. If problems have emerged, they sell and move on without dwelling on the loss. The journey from novice to skilled investor requires embracing discomfort. Your first major loss will sting. Your second will hurt less. By your fifth significant mistake, you'll analyze it calmly and adjust your strategy accordingly. This emotional evolution is just as important as learning financial analysis techniques. Remember that every investing legend has a graveyard of failed investments behind their success stories. The difference is that they learned from each failure and never repeated the same mistake twice. Your willingness to learn from errors, adapt your approach, and maintain confidence despite setbacks will determine your ultimate success in building wealth through value investing. Part 4. Your investing adventure continues. Your journey into value investing has reached a pivotal moment. The lessons you've learned, the mistakes you've analyzed, and the discipline you've developed have prepared you for the adventure ahead. This isn't the end of your education, but the beginning of your transformation from student to practitioner. Every successful investor started exactly where you are now, armed with knowledge and ready to take action. The path forward requires courage, patience, and commitment, but the rewards extend far beyond financial gains. You're about to discover that investing is not just about money, but about building confidence, discipline, and a deeper understanding of how markets and businesses work. Your investing adventure starts with a single decision. Consider Lisa, a teacher who read about value investing at age 28. She had saved $2,000 and felt overwhelmed by the complexity of financial markets. Instead of letting fear paralyze her, she invested in her first undervalued stock after careful research. That decision changed her life. 25 years later, her portfolio has grown substantially, funding her children's education and providing financial security. Lisa's story isn't unique because she was brilliant or lucky. She succeeded because she took action and stayed committed to proven principles. The first step in your adventure is remarkably simple. Start where you are with what you have. David, a mechanic from Ohio, began investing with just $500. He couldn't afford expensive research tools or financial advisors. Instead, he used free resources, read annual reports during his lunch breaks, and gradually built his knowledge. His initial investments were small, but his commitment was enormous. Over time, his understanding deepened, his confidence grew, and his portfolio expanded. Today, David owns a diversified collection of quality companies that generate steady returns. What story do you want to tell about your financial future? The beauty of value investing lies in its accessibility. You don't need advanced degrees, expensive software, or insider connections. You need patience, discipline, and willingness to learn. Every piece of knowledge you've gained from studying balance sheets, calculating intrinsic value, and understanding market psychology becomes a tool in your investing toolkit. Your adventure will include moments of doubt and periods of excitement. Markets will fluctuate, headlines will create panic, and well-meaning friends will offer conflicting advice. Remember Emma, who started investing during a market downturn. While others sold in fear, she saw opportunity. Her careful analysis revealed quality companies trading at significant discounts. She bought steadily, ignored the noise, and watched her investments recover and grow as markets normalized. Her success came not from timing the market, but from understanding value and maintaining discipline. The practical next steps are straightforward but powerful. Begin by setting aside a specific amount each month for investing, even if it's modest. Consistency matters more than the initial amount. Create a simple system for tracking potential investments. This might be a spreadsheet listing companies you're researching, their current prices, and your calculated intrinsic values. Review your holdings regularly, but resist the urge to make frequent changes based on short-term market movements. Building your investing knowledge never stops. Read annual reports of companies you find interesting. Follow industry trends that affect your investments. Study the decisions of successful value investors and understand their reasoning. Join online communities where investors share insights and discuss strategies. This continuous learning keeps your skills sharp and your perspective fresh. How will you know when you're ready to increase your investing commitment? Trust develops gradually through experience. Start small, learn from each decision, and slowly expand your activities as your confidence grows. Mark, a software developer, began by investing 10% of his savings. As his knowledge and comfort increased, he gradually expanded his investing activities while maintaining his focus on quality companies at reasonable prices. Your financial future depends on the actions you take today. Every successful investor faced the same choice you face now: continue learning passively or begin applying knowledge actively. The difference between dreamers and achievers is action. Value investing provides a proven framework for building wealth, but frameworks require implementation to create results. The adventure ahead offers more than financial rewards. You'll develop analytical skills, emotional discipline, and long-term thinking that benefit every area of your life. You'll understand businesses better, make more informed financial decisions, and gain confidence that comes from taking control of your financial destiny. Your story is beginning, and every chapter you write through disciplined investing brings you closer to the financial freedom you seek. Chapter 5: The Value Investor's Toolkit. Part 1: Questions to ask before you buy. Smart investors turn potential disasters into profitable decisions by asking the right questions before they buy. This critical evaluation process separates successful value investors from those who chase trends and lose money. Learning to systematically assess companies through proven questions transforms investing from gambling into a disciplined craft. The framework outlined here builds confidence through clarity, helping readers identify genuine bargains while avoiding costly mistakes. These simple yet powerful questions serve as your investment compass, guiding decisions with the wisdom of legendary value investors who have consistently beaten the market. The power of asking questions before investing cannot be overstated. When Marcus Chen decided to invest his savings in 2019, he almost bought shares of a trendy tech company everyone was talking about. Instead, he stopped and asked himself a simple question: do I understand what this business actually does? His honest answer was no. That single question saved him from losing 40% of his investment when the stock crashed 6 months later. This same questioning approach helped veteran investor Elena Rodriguez build her wealth over 30 years. She never buys a stock without first answering 5 fundamental questions. Her disciplined process has helped her avoid major market crashes while identifying companies that doubled or tripled her money. What does this business actually do, and how does it make money? This first question seems basic, but it eliminates more bad investments than any complex analysis. If you cannot explain the business model to a 12-year-old, you should not invest. Consider the case of David Park, who almost invested in a biotechnology company with impressive growth numbers. When he tried to explain their business model, he realized they had no approved products and were burning through cash with no clear path to profitability. Companies with simple, understandable business models often perform better than complex ones. Warren Buffett famously avoided technology stocks for decades because he could not understand their competitive advantages. McDonald's sells hamburgers, Coca-Cola sells beverages, and Apple sells consumer electronics. Simple businesses are easier to evaluate and predict. Is this company profitable, and has it been profitable for several years? Consistent profitability indicates a business that can generate cash regardless of economic conditions. Look for companies that have made money in at least 4 of the past 5 years. This consistency shows management can adapt to changing conditions while maintaining profitability. Take the example of Lisa Thompson, who compared 2 retail companies in 2020. Company A had impressive revenue growth but had lost money 3 out of 5 years. Company B grew more slowly but had been profitable every year for the past decade. When the pandemic hit, Company A filed for bankruptcy while Company B survived and thrived. Consistent profitability acts as a safety net during difficult times. How much debt does the company carry compared to its earnings? Debt can destroy even profitable companies when economic conditions worsen. A simple rule is to avoid companies where total debt exceeds 5 times annual earnings. Companies with little or no debt have more flexibility to invest in growth opportunities and survive economic downturns. Consider what happened to James Miller's investment in a restaurant chain. The company looked attractive with growing sales and expanding locations. However, James failed to notice their debt was 8 times their annual earnings. When interest rates rose and sales declined slightly, the company could not service its debt payments and eventually went bankrupt. What do you think makes this company different from its competitors, and can that advantage last? Every successful investment requires a competitive advantage that protects the business from rivals. This might be a strong brand, exclusive technology, regulatory protection, or cost advantages from scale. When Rachel Kim evaluated grocery chains, she noticed one company consistently had higher profit margins than competitors. Further research revealed they owned their real estate while competitors rented their stores. This ownership provided cost advantages and asset backing that would be difficult for competitors to replicate quickly. Does the current stock price make sense compared to the company's earnings and assets? This question gets to the heart of value investing. Even the best company can be a poor investment if you pay too much. Compare the stock price to annual earnings, book value, and similar companies to determine if you are getting good value. Think about buying a house. You would compare prices of similar homes in the neighborhood before making an offer. Stock investing requires the same approach. If a company trades at 30 times earnings while competitors trade at 15 times earnings, you need compelling reasons to pay the premium. Are you prepared to hold this investment for at least 3 to 5 years? Short-term stock movements are unpredictable, but business fundamentals tend to drive long-term returns. If you cannot commit to holding for several years, you are speculating rather than investing. How confident are you that this industry will exist and remain profitable in 10 years? Technological change and consumer preferences can make entire industries obsolete. The newspaper industry was highly profitable for decades before the internet changed everything. Similarly, traditional taxi companies struggled when ride-sharing services emerged. What is the worst thing that could happen to this investment, and could you live with that outcome? This question forces you to consider downside risks honestly. If losing this money would significantly impact your financial security, you should either invest less or choose safer alternatives. Consider the experience of Tom Bradley, who invested his entire emergency fund in what seemed like a sure thing. When the company faced unexpected problems, Tom was forced to sell at a loss to pay for a medical emergency. He learned that even good investments can experience temporary setdowns. The most successful investors use these questions as a checklist, never buying without satisfactory answers to each one. This systematic approach removes emotion from decision-making and prevents costly mistakes that destroy wealth over time. Part 2. Red flags and green lights. Learning to spot the difference between a company heading for trouble and one poised for growth can mean the difference between losing your life savings and building lasting wealth. Every successful value investor develops an instinct for reading the signs that separate winners from losers. This skill comes from understanding what to look for and practicing until pattern recognition becomes second nature. The stories and indicators in this section will help you develop these crucial instincts and avoid the expensive mistakes that destroy portfolios. Every experienced investor has learned the hard way that not all cheap stocks are good deals. Consider what happened to Lisa Chen, a nurse who thought she found the perfect bargain. A pharmaceutical company's stock had dropped from $40 to $8 per share. The price looked attractive, especially since the company had been profitable for years. Lisa bought 500 shares, convinced she was getting a steal. Within 6 months, the stock fell to $3. Lisa discovered too late that the company was facing multiple lawsuits over a drug that caused serious side effects. The legal costs were mounting, and insurance coverage was limited. She had focused only on the low price and ignored the warning signs that experienced investors would have spotted immediately. The first red flag Lisa missed was the unusual trading volume. When a stock drops significantly on heavy trading, it often means informed investors are rushing to sell. This pattern suggests that people with inside knowledge believe bad news is coming. Smart investors pay attention to volume spikes, especially when they coincide with price drops. Another warning sign was the company's debt level. Pharmaceutical companies facing lawsuits need cash to pay legal fees and potential settlements. Lisa's company had borrowed heavily in recent quarters, and its debt-to-equity ratio had doubled. High debt levels become dangerous when revenues are uncertain or declining. Companies with too much debt often cut dividends, lay off workers, or even file for bankruptcy. The executive departures should have been the final warning. 3 senior executives had left the company in the past year, including the chief financial officer and head of research. When key leaders abandon ship, they often know something that outside investors don't. Executive turnover, especially in critical positions, suggests internal problems that may not yet be public. How often do you check for these warning signs before making an investment decision? The most successful investors create mental checklists and never skip these basic safety checks. Green lights are just as important as red flags. Rachel Torres learned this lesson when she almost passed up one of her best investments. A small regional bank stock had been declining for months after a competitor opened a branch in the same town. Most investors assumed the increased competition would hurt profits permanently. Rachel dug deeper and discovered several positive indicators. The bank's loan default rate was actually improving, suggesting good management and careful lending practices. Customer deposits were growing despite the new competition, which meant people trusted the institution. The bank was also earning higher interest rates on its loans than its competitors, indicating superior service or relationships. Most importantly, the bank was buying back its own shares. When management uses company cash to purchase stock in the open market, it signals confidence in the business. Share buybacks only make sense if executives believe the stock price is below the company's true value. This green light proved accurate when the bank's stock doubled over the following 2 years. Strong cash flow represents another powerful green light. Companies that generate consistent cash from their operations have flexibility to weather problems and invest in growth. Marcus Webb found this pattern when researching a small manufacturing company. Despite reporting modest profits, the company was generating substantial cash because it had already written off most of its equipment costs. This cash flow strength allowed the company to modernize facilities and expand into new markets. Companies with competitive advantages often display specific green lights. These might include exclusive contracts, patents, strong brand recognition, or unique locations. A convenience store chain caught investor attention because it secured exclusive rights to operate in highway rest areas across 3 states. This geographic monopoly protected it from competition and guaranteed steady traffic. Consistent dividend payments over many years signal financial stability and management discipline. Companies that maintain dividends during economic downturns demonstrate both financial strength and commitment to shareholders. However, investors must verify that dividend payments come from genuine profits rather than borrowed money. What competitive advantages does your favorite company possess, and how durable are they? This question separates amateur investors from professionals who understand business fundamentals. The timing of insider buying provides valuable intelligence about a company's prospects. When executives and directors purchase stock with their own money, especially during market declines, they're betting their personal wealth on the company's future. Insider selling is less meaningful because executives sell for many personal reasons, but insider buying almost always reflects genuine confidence. Kevin Park discovered this principle when researching a troubled retail chain. The stock had fallen 60% after several quarters of disappointing sales. Most investors were avoiding the company, but Kevin noticed that 3 board members had purchased significant amounts of stock in recent weeks. Their buying suggested they believed the problems were temporary, and the stock price had overreacted. The company's turnaround took longer than expected, but Kevin's patience was rewarded when new management strategies began working. The stock eventually recovered and provided him with substantial gains. The insider buying had been an early signal that knowledgeable people saw value where others saw only problems. Financial ratios provide objective measures of company health, but they must be interpreted correctly. A low price-to-earnings ratio might indicate a bargain or a company with serious problems. The key is comparing ratios to industry averages and the company's historical performance. Sudden changes in key ratios often signal important developments that require investigation. Building the instinct to recognize red flags and green lights takes practice and experience. Start by studying companies you know well, looking for patterns that preceded both successes and failures. Over time, these patterns become second nature, helping you make better investment decisions and avoid costly mistakes that destroy wealth. Part 3. Building your watch list. Think of your watch list as your personal treasure map. Building this collection of potential investments puts you ahead of other investors who wait until they have money before they start looking. When opportunities appear, you'll be ready to act while others scramble to research companies from scratch. This systematic approach transforms you from a reactive buyer into a prepared hunter, positioning you to capitalize on market downturns and temporary price drops that create wealth for patient investors. Creating your watch list starts with companies you understand. Emma, a teacher, began her investing journey by tracking companies she encountered daily. She noticed parents constantly buying products from certain brands and teachers relying on specific educational software. Instead of dismissing these observations, Emma started a simple spreadsheet listing these companies along with basic information about their business models. The key is starting simple. Your initial watch list doesn't need complex formulas or professional software. A basic spreadsheet with company names, ticker symbols, current prices, and brief notes about why each company interests you provides an excellent foundation. Many successful investors still use this approach decades into their careers. What companies do you interact with regularly that seem to have strong customer loyalty? These everyday observations often lead to the best investment discoveries. Tracking your companies requires consistent monitoring without becoming obsessive. David, a mechanic, checks his watch list every Sunday morning with his coffee. He updates stock prices, reviews recent news, and adds notes about any significant developments. This weekly rhythm keeps him informed without letting market noise distract him from his day job. Modern technology makes tracking easier than ever. Most brokerage platforms offer free watch list tools that automatically update prices and provide basic company information. Popular options include Yahoo Finance, Google Finance, and broker-specific platforms like Fidelity or Charles Schwab. These tools send alerts when stocks hit certain price levels, helping you stay informed without constant monitoring. Setting up price alerts transforms your watch list from a passive list into an active tool. When Rachel identified a strong company trading at what she considered an expensive price, she set an alert for 20% below the current price. 6 months later, during a market correction, her alert triggered. While other investors panicked, Rachel calmly reviewed her research and bought shares at her target price. Price alerts work best when tied to your valuation research. Calculate what you believe each company is worth, then set alerts at prices that provide adequate safety margins. This approach removes emotion from your buying decisions and helps you capitalize on temporary market pessimism. Organizations separate successful watchlist builders from casual observers. Categories help manage larger lists effectively. Technology companies, consumer goods businesses, healthcare firms, and financial institutions each have different characteristics and evaluation criteria. Grouping similar companies makes comparison easier and helps identify which sectors offer the best current opportunities. Your watchlist categories should reflect your knowledge and interests. If you work in healthcare, that category might contain more companies than others. If you understand retail businesses well, consumer companies might dominate your list. Playing to your strengths increases your chances of making sound investment decisions. Regular watchlist maintenance prevents information overload and keeps your focus sharp. Tom, an accountant, reviews his entire watchlist quarterly, removing companies that no longer meet his criteria and adding new prospects he's discovered. This discipline keeps his list manageable and relevant. How many companies can you realistically follow without losing focus on the most promising opportunities? Quality beats quantity when building your watch list. Following 50 companies superficially produces worse results than deeply understanding 20 companies. Professional investors often track fewer than 30 companies at any given time, allowing them to develop detailed knowledge about each business. Research integration makes your watch list more valuable over time. As you gather information about each company, document key findings directly in your tracking system. Note important financial ratios, competitive advantages, management quality, and potential risks. This accumulated knowledge becomes invaluable when making actual purchase decisions. Consider Lisa's experience with a restaurant chain on her watch list. Over 18 months, she tracked company's expansion plans, menu changes, customer reviews, and financial performance. When food costs spiked industry-wide and the stock price dropped 30%, Lisa had enough background knowledge to recognize this as a temporary problem rather than a permanent business decline. Her patient research paid off when the stock recovered within 2 years. Watchlist discipline requires ignoring short-term price movements that don't reflect business fundamentals. Market prices fluctuate constantly based on news, emotions, and trading activity that has nothing to do with underlying company value. Your watch list helps you focus on business performance rather than daily price changes. The best watch list builders think like business owners rather than stock traders. They ask whether they would want to own the entire company at current prices, not whether the stock might go up next week. This long-term perspective helps filter out companies that might be popular trading vehicles but poor long-term investments. Patience becomes your greatest advantage when maintaining a quality watch list. Some companies might trade above your target price for years before offering attractive entry points. Others might provide multiple buying opportunities during their time on your list. Your watch list keeps you prepared for both scenarios. Building and maintaining a watch list requires minimal time but provides maximum preparation for investment success. This systematic approach transforms market volatility from a source of anxiety into a source of opportunity, positioning you to benefit when fear drives prices below intrinsic value. Your watch list becomes a living document that grows more valuable as you add research and experience. Companies that seemed attractive initially might reveal problems over time, while others might prove more valuable than your initial assessment suggested. This evolution reflects your growing expertise as an investor. The most successful value investors treat their watch lists as competitive advantages, giving them deep knowledge about potential investments before opportunities arise. When market conditions create attractive prices, they act decisively while others struggle to evaluate unfamiliar companies under pressure. Part 4. Writing your own story. Value investing extends far beyond picking stocks and analyzing numbers. It represents a personal journey of learning, growth, and financial wisdom that evolves with each decision you make. The strategies and principles you've explored become the foundation for your unique investing story, one that will span decades and adapt to changing markets, personal circumstances, and life goals. This journey requires not just technical knowledge, but also self-awareness, patience, and the courage to stay true to your convictions when others lose faith. The transformation from novice to experienced value investor happens gradually through practice and reflection. Consider Emma, a teacher who started investing 3 years ago with just $5,000. She began by following basic value principles, buying stocks when they traded below book value and selling when they reached fair value. Her first year brought modest gains, but more importantly, it taught her about her own emotional responses to market volatility. She documented each trade, noting not just the financial outcomes, but also her thought process and feelings during different market conditions. Emma's investing journal became her most valuable tool. She recorded why she bought each stock, what she expected to happen, and how reality compared to her expectations. When her second-year returns lagged the market, she felt tempted to abandon value investing for trendy growth stocks. However, reviewing her journal revealed that her mistakes came from rushing decisions rather than from flaws in value principles. This insight helped her develop patience and stick to her strategy. Have you considered how you'll measure success beyond just returns? True value investing success encompasses growing confidence in your analytical abilities, developing emotional discipline, and building wealth steadily over time. The most successful value investors create personal frameworks that match their circumstances and goals. Marcus, a software engineer with a demanding job, developed a simple system focusing on dividend-paying value stocks in industries he understood. He allocated just 2 hours each weekend to research, preferring thorough analysis of fewer companies over superficial coverage of many. His approach differed dramatically from retired Professor Linda, who treated investing like a part-time job, spending hours daily reading annual reports and industry publications. Both investors succeeded because they built systems aligned with their available time, interests, and risk tolerance. Marcus accepted that his limited research time meant missing some opportunities, but his focused approach led to better decisions within his chosen companies. Linda's extensive research allowed her to find obscure value opportunities, but required significant time commitment that worked for her retirement lifestyle. Your personal investing story should reflect your unique situation. A young professional might focus on growth-oriented value stocks that compound over decades, while someone nearing retirement might emphasize dividend-paying value stocks for current income. The fundamental principles remain consistent, but their application varies based on individual circumstances. Documentation plays a crucial role in your investing development. Beyond tracking returns, maintain records of your reasoning, mistakes, and lessons learned. When tech stocks soared in 2021, many value investors felt left behind. Those who documented their decision-making process during previous market cycles had concrete reminders of why they chose their approach and how patience had rewarded them before. Creating an investment thesis for each position forces clarity in your thinking. Write down why you're buying, what you expect to happen, your target price, and potential risks. This practice prevents impulse decisions and provides valuable learning material for future analysis. What personal investing rules will guide your decisions when emotions run high? Successful value investors often develop simple guidelines that help them stay disciplined during challenging periods. Market cycles provide the ultimate test of your commitment to value principles. During the 2020 pandemic crash, Experienced value investor Carlos saw his portfolio drop 40%, while growth stocks quickly recovered. His documentation from previous downturns reminded him that value stocks often lagged during recoveries, but eventually outperformed. Instead of switching strategies, he increased his buying during the downturn, purchasing quality companies at exceptional prices. Setting realistic expectations prevents disappointment and strategy abandonment. Value investing typically produces steady returns over long periods rather than spectacular short-term gains. Understanding this reality helps you stay committed when flashier strategies seem more attractive. Your investing story will include setbacks and mistakes. These experiences, while painful, often provide the most valuable lessons. The key lies in learning from errors without letting them derail your long-term approach. Every successful value investor has stories of stocks that didn't work out, but they also have examples of patience being rewarded handsomely. Building a support network of like-minded investors can strengthen your resolve during difficult periods. This might involve joining investment clubs, participating in online forums, or simply finding a few friends who share your investing philosophy. Having others to discuss ideas with and learn from accelerates your development. The beauty of value investing lies in its accessibility and adaptability. Whether you start with $500 or $50,000, the principles remain the same. Your story begins with your first investment decision and continues for as long as you remain engaged with the markets. Each choice you make, each lesson you learn, and each challenge you overcome adds another chapter to your personal investing narrative. Remember that your investing journey is uniquely yours. While you can learn from others' experiences and apply time-tested principles, your path will reflect your personality, circumstances, and goals. Embrace this individuality while maintaining discipline in your approach. Your story of value investing success is just beginning, and the next chapter starts with your very next investment decision.